When you think about what happened at Starwood and what has been happening at BREIT, can you kind of explain what the differences and maybe even similarities were?
Sure. Thanks for having me on, Sonali. You know, if you take a step back, we started BREIT 7.5 years ago with the idea of delivering institutional quality real estate to individuals. And the thing we're most proud of is performance to start. We've delivered a 10.5% net annualized return over 7.5 years, which is 3 times the return of the listed REITs during that time period. Why did we do that? How did we do that? It's because BREIT is differentiated. We own in BREIT the fastest growing data center business in the world. We're the largest owner of student housing in the United States. The other non-traded REITs don't have these assets. We're in the Sun Belt. We avoided buying office buildings and malls. Now, in terms of liquidity, in terms of flows, our semi-liquid structure has worked over the last 18 months exactly as designed. We have no plans to change our repurchase program. What we've seen, in fact, is a material decline in redemption requests over the last 18 months, down 70%. We fulfilled 100% of redemption requests over the last 4 months. Today, we have ample liquidity, $7 billion plus. That is what differentiates us from other players in the space.
Well, you made this really interesting decision in May to go beyond that 2% limit that typically exists for BREIT for investors. Bring us behind why you made that decision.
Sure. So what we're really looking at when we step back is this bigger trajectory, the trend, which is the decline over the last 18 months. Now, over the last 4 months, as I said, we paid out 100%. In the month of May, what we saw was that in the first 2 weeks, we were in line with the prior month of April. In the last 2 weeks, not surprisingly, in light of SREIT's announcement and the noise in the system, we saw an uptick in redemption requests. Nothing like what we saw last year, but an uptick nonetheless. BREIT's independent board made the decision to pay out 100% of repurchase requests in the month of May, given our strong liquidity position, given the longer term trend. I think the most important thing to emphasize, though, is that we're not changing our structure. We're not changing the program, and we're not going below those stated limits.
Well, what can you do for June? How are things going so far this month? And if you were to hit that 2% limit again, could you make that same decision to go beyond that limit to give money back to investors if needed?
Listen, you know, being 6 days into the month, it's really hard to speculate on where repurchase requests end for the full month. In addition to that, it is a decision that's ultimately made by the independent board of BREIT. What I think our investors can take a lot of comfort in is not just the performance and the high growth that we're seeing in the portfolio, but we have more than $7 billion of liquidity. We've proven over the last 18 months that the structure works as designed. And I want to be really clear that we have no plans to change that repurchase program, and we have no plans to go below those limits.
So it's interesting because you mentioned the May issue around SREIT and how that created more noise. When you look at the industry, the REIT industry right now, how much more noise is there? Is there a lot of other troubles brewing around that you may even try to capitalize on? Could you go out and buy a REIT?
Well, what I would say is that I think what the last 18 months have shown, specifically in the context of BREIT, is that even in a moment of heightened volatility, the model really works. So what is the model? Why did we create BREIT? The idea was that you deliver higher returns in exchange for a measure of liquidity. And that's what we've delivered. As I said, 3 times higher returns than the REITs. And we've also provided liquidity to our investors. Every investor who has wanted their money back has gotten it. I think that if I think about the model, these 18 months have really demonstrated the validity of the model, that the structure works, and I think that, frankly, increases long-term confidence in what we've built.
But that's for you guys. What about everybody else? If across the industry, there are still interest rates standing higher than they were several years ago. There are still pressures on the real estate market.
I think that's exactly right, and that's why who you invest with matters so much, where you invest matters so much. It's why we've been so clear with our investors and with anyone who will ask that you want to own assets in sectors with growth. You want to avoid owning challenged assets in challenged markets. That's exactly how we designed BREIT. That's why we've outperformed. I think in moments like this, and we saw this, frankly, coming out of the global financial crisis. Coming out of the global financial crisis, most of our competitors were struggling to return their investors' original capital back. We, at that time, tripled our money on major investments like Hilton, Equity Office. What we showed during that time, what we've shown over 3+ decades, is that the better managers do outperform. We think BREIT's an example. But there are others who will have challenges in this environment.
Now, if you take a look around also, it's not just other REITs having challenges. The real estate market has seen a repricing. Your president here, Jonathan Gray, has gone out and said, it's time. It's time to be spending some money. How much money are you spending and where are you spending it?
So it's one of the most exciting opportunities we've seen in a long time. If you take a step back, we look at the real estate cycle, and yes, there's been bad news, higher interest rates and challenges in the office business. But we believe a lot of that bad news is now priced into asset values. Values are bottoming. Now is the time to play offense. The cost of debt has come down. The availability of debt has improved. New construction has come down dramatically. That creates the foundation for a recovery. In that mode where the sentiment will remain negative because there will be losses associated with deals that were financed in a different environment, sentiment will remain negative. Well, when you see green shoots and you see negative sentiment, you play offense. We've deployed nearly $20 billion of equity globally in just the last 6 months in our highest conviction sectors, because we think now is the time to be aggressive. And we're not going to wait for the all clear sign, because once that comes, it's too late.
Do you think it's only June? We just started June. The second half of the year, could you be at more than 20 billion?
Indeed, it's possible. Our pipeline today is as big as we've seen in 18 months. We recently announced 2 large-scale privatizations in the rental housing space in the U.S. We privatized Air Communities, a $10 billion company that owns high-quality apartments on the coasts. We announced the privatization and closed on the purchase of Tricon Residential, single-family homes in the Sun Belt, places we really like. We love data centers. We announced a $7 billion joint venture with Digital Realty in that area recently. We're heavily deploying in warehouses on the back of e-commerce strength, and that is our biggest exposure by far globally. And our pipeline really is reflective of those same themes, and we're pretty excited today about that pipeline.
Nadeem, Blackstone was really well known for kind of cleaning up the portfolio early on. And when you think about it, yes, you have a big buying opportunity ahead of you, but what about the selling opportunity? Do you feel that you have to sell some assets here to meet liquidity needs or otherwise at this point in time?
The way we're structured in all of our vehicles is that we're never a forced seller. So the idea for us is always you sell real estate when it makes sense, when you've completed your business plan, when you can get a great price. And one of the things I would point out in that regard is we have sold just out of BREIT $20 billion of assets over the last 2 years as rates began to increase, 374 individual assets. Those sales generated $4 billion of profit. We also happen to sell above our marks. I think the idea is if you own high quality real estate in the right asset classes today, there's a lot of liquidity. In fact, when you take an apartment building out to market today, we see 3 times as many bidders as we saw only 6 months ago. And what's happening on the ground, and again, the headlines don't capture this, is that buyers are seeing the cost of capital come down and they're seeing new supply come down. Liquidity is coming back into the private market, and we take advantage of that when it makes sense in our own portfolio to sell.